Now let us consider a more complex world where we have two risky assets, stocks, for example, the S&P 500 index, and bonds, for example, the Barclays aggregate bond index. Suppose you had $100,000. How much of your wealth will you allocate to stocks and how much would you allocate to bonds? Now let us again consider the mean variance framework where you have expected return on the y-axis and volatility on the x-axis. Stock portfolio is represented by point S, and the bond portfolio is represented by the point B. And as you can see, the bond portfolio has a lower risk but also a lower return as compared to the stock portfolio. Now, if the correlation coefficient between stocks and bonds is +1, then the investment opportunity set would be a straight line. But if the correlation is less than 1, then the investment opportunity set is a curve like this. So by comparing the yellow line with the black line, one can immediately see the benefits of diversification. For the same expected return, one can obtain a lower level of risk on the yellow line as compared to the black line, or stated differently, for the same level of risk, one can obtain a higher return in the yellow line as compared to the black line. So let's consider a case where the correlation between stocks and bonds is around 0.3. In that case, the investment opportunity set is represented by the blue curve. Now, the portfolio optimization problem for the investor requires us to superimpose the utility curve on this mean variance framework. So if we begin with an investor's utility curve U1, then the possible points of allocation are here and here, but the investor can do better by pushing out, and if they push out, then they can reach U2, which is better than U1, and if they push out even more, the best that they can do would be U3, and so U3 in this case is the optimal allocation of the investor's portfolio. The algebraic expression for the portfolio allocation problem in the case of two risky assets is represented in this slide. The objective is to maximize the investor's utility subject to the available investment opportunity set. The utility function is represented by a simple framework comprising of expected return and volatility, just the two moments of the return distribution. And the investment opportunity set is represented by the blob comprised of the return and volatility expression. To solve the optimization problem, set up the Lagrangian equation, differentiate with respect to either W1 or W2, and set up the first order condition to be equal to 0 and solve for the optimal allocation. Now let's bump up the complexity a notch by considering a world where there are two risky assets, in our case a portfolio of stocks and a portfolio of bonds, and we also have a risk-free asset such as a treasury bill. How would we allocate our wealth, say $100,000, across these three asset classes? The graphical representation of the problem is as follows. S represents stocks, B represents bonds, and RF represents the risk-free asset, and we are in the mean variance framework. Now, considering first the two risky assets, stocks and bonds, say with a correlation of 0.3, the set of possible investment opportunities would be a blob, so it would look something like this. Now each point here represents a certain combination of stocks and bonds. So for example, this point might be 50% stocks, 50% bonds, whereas this point might be close to 100% stocks and 0% bonds, and this point would be close to 100% bonds and 0% stocks. Every point on the blob is a risky portfolio, so it's possible to combine the risk-free asset with each of the points on the blob, and the combination would be the capital allocation line. In this illustration, we begin with the point X and draw the cal from the risk-free asset to the point X, which would have a slope which is equal to the risk premium divided by the sigma. Now, if we compare point X to point Y, we will see that the slope in the case of point y is higher than in the case of point x, implying that for each unit of assumed risk, the risk premium that the investor obtains would be higher along this cal than it would be along this cal. Therefore, regardless of the degree of risk aversion, all investors would prefer to be along the line RF to Y than along the lines RF to X. Once we have identified Y as the optimal point along the blob from S to B, we can ignore all the other possible combinations along SB. Focusing on RF to Y, the next step would be to superimpose the utility curve and then to keep pushing the utility curve until the point when the utility curve is just tangent to the line RF. The tangency point Y star is the optimal allocation for this investor on the capital allocation line. To note, suppose that we had $100,000 to invest, and suppose the Y star is equal to 0.65, then it means that 35% of 100,000, which is 35,000, will be invested in the risk-free asset, and the remaining 65%, which is $65,000, would be invested in this portfolio Y, which is a tangency portfolio. Y itself might be comprised of 60% stocks and 40% bonds, which means that 60% of 65,000 will be invested in stocks, and the remaining 40% of 65,000 will be invested in bonds. The algebraic expression to find the tangency portfolio P is as follows. Our objective is to maximize the Sharpe ratio to find the tangency portfolio subject to the investment opportunity set. So the optimization objective function is to maximize the Sharpe ratio, as you see here, and the investment opportunity set is as described below, which is the return and standard deviation in the case of two risky assets. So set up the Lagrangian equation, differentiate with respect to the choice variables, which are the allocations to the stock or to the bond, W1 or W2, differentiate, obtain the first order condition, equate it to 0, and then solve in order to obtain W1 star and W2 star. As you know, the real world is a lot more complex. In addition to portfolios of stocks and bonds, you have, in fact, the individual securities that makes up a portfolio of stocks and bonds, and therefore you would have combinations that you need to work through in order to find out the efficient frontier. Once you find out the efficient frontier, you would then identify the cal, which has the highest slope using the risk-free rate and each of the points on the efficient frontier. Once you have the cal, then you can ignore all the other combinations on the efficient frontier and then simply superimpose the utility function to find the tangency portfolio. Let's now discuss a very important idea, the two-fund separation property, that is related to Harry Markowitz's work, for which he won the Nobel Prize in Economics in 1990. His paper, Portfolio Selection, was published in the Journal of Finance in 1952. So let's consider three investors with different risk profiles. A conservative investor C, who can handle much risk, an investor with moderate risk profile M, and an aggressive investor who can take on a lot of risk. Now, intuitively, one would assume that the portfolios of these three investors are going to be very different. Harry Markowitz's work showed that this intuition actually does not flow through. To the extent that all three investors have access to the same information set, they would plot the same efficient frontier. And since they plot the same efficient frontier, they would all select the same risky portfolio P, which is the portfolio with the highest Sharpe ratio. However, where they sit on the capital allocation line is going to be different, driven by their risk aversion. The more aggressive investor might invest more of the portfolio in the risky asset P and less in the risk-free asset, while the conservative investor might come further down the capital allocation line towards the risk-free asset and invest more in the risk-free asset and less in the risky portfolio P. This is obviously a very novel and not intuitive insight, and for this reason, Harry Markowitz won the Nobel Prize for his contributions to our understanding of portfolio construction. A few key insights from our discussions. Risk specific to a single investment can be eliminated through diversification. substantial diversification benefits begin with as few as 10 different assets. One low risk asset has more risk than a portfolio of 10 high risk but unrelated assets. Some asset classes are not highly correlated with domestic US equities, so investors should allocate a portion of their assets to these asset classes. Finally, one needs to avoid some common investment pitfalls. The first being market timing, which is a belief that one has the ability to forecast stock returns over a short horizon. Inertia, which is the problem of not rebalancing the portfolio in a timely manner. And finally, asset location, which is the strategy of locating high tax assets, such as corporate bonds, in a tax protected account, and low tax rate assets, such as stocks, in a taxable account.